Imagine 13 million people all receiving a text message at the exact same second, right? And the message tells them to drop whatever they're doing and just rush through a single narrow door.
Yeah, that sounds like a nightmare.
Right. But, I mean, that is essentially what's about to happen to the U.S. financial system the very second mortgage interest rates drop. So today, we are looking at the hidden digital plumbing that will either keep that entire system from collapsing or, just fail completely under the pressure.
It's a phenomenal image, actually, and it perfectly captures the reality of real estate infrastructure. Because, while most people are obsessively watching housing prices to gauge the economy...
Which is what everyone does, yeah.
Right, exactly. But the background machinery, the appraisals, the title searches, the network management, that is actually where you can see the truest, earliest indicators of market momentum. If you want to know where the global housing market is going, you don't look at the curb appeal, you look at the plumbing.
And that is exactly our mission for you today on this Deep Dive. So today is May 1, 2026, and we are unpacking the brand new Q2 2026 financial results from Real Matters, Inc.
Right.
They operate this centralized network management services platform for the mortgage and insurance industries. Essentially, they're the digital glue connecting massive lenders with tens of thousands of independent appraisers and title agents out in the field.
Yeah, which is a massive logistical undertaking.
For sure. And we're going to uncover what their latest quarter reveals about how a company quietly scales in a, heavily fluctuating market, and what their internal data tells us about the broader economic landscape of housing and refinancing.
What's fascinating here is that this particular quarter, which ended March 31st, 2026, it represents a major inflection point. The real estate market globally has been locked in this deep freeze over the last couple of years, mostly due to elevated interest rates. So seeing the granular mechanics of how a network platform like Real Matters navigates the beginning of that thaw, it tells us a lot about the survival of the fittest in corporate tech.
Okay, let's unpack this structural shift, starting right at the top of their income statement. Looking at their consolidated financial results for the second quarter, they are showing a very distinct return to profitability.
They are, yeah.
Consolidated revenues hit $47.2 million. That is up 27% year over year. Their consolidated net revenue reached $13.6 million, which is a 35% jump.
Which is solid growth.
It is. But the number the CEO, Brian Lang, heavily emphasized was their adjusted EBITDA. They hit a positive $0.9 million, which bounces back from a loss of $1.9 million in the exact same quarter last year.
Right.
And net income also swung positive to $1.2 million, up from a $2.2 million loss a year ago.
And, in his commentary, the CEO specifically pointed to their meaningful operating leverage. He noted the platform's ability to convert incremental net revenue into adjusted EBITDA at a really high rate.
Right.
That phrase, operating leverage, is the conceptual key to unlocking this entire business model.
Okay, let's pause there because we need to define our terms for the listener. EBITDA, earnings before interest, taxes, depreciation, and amortization. Basically, it's a way to measure the raw cash profit generated strictly by the day-to-day operations, before the accountants start moving things around.
Exactly, yeah.
But I have to push back on the enthusiasm here. I'm looking at a $0.9 million adjusted EBITDA profit on $47.2 million in total revenue.
Right.
That is a microscopic fraction of a percent of overall revenue actually making it to that adjusted profit line. So why is the executive team treating a sub $1 million operational profit as a massive structural victory?
Oh, I completely understand the skepticism. If you just look at the raw absolute dollar amount, it doesn't look like a windfall.
No, it doesn't.
But in the context of network technology platforms, the raw number today matters far less than the underlying mechanism and the trajectory. This is their strongest result in 7 quarters.
Wow.
Yeah. For the better part of 2 years, they've been operating in this harsh mortgage winter where transaction volumes just plummeted. The fact that they survived that winter without dismantling their core network infrastructure is critical.
So it's about proving the floor of the business model.
Exactly. And this goes back to understanding operating leverage. Think of their business like a massive digital toll road.
Right.
Building that road in the first place, writing the complex software, building secure compliance protocols, establishing connections with tens of thousands of independent contractors. That requires immense upfront capital. It's a massive fixed cost.
Right.
But once the road is built and fully operational, every extra car that drives on it costs almost nothing to process.
So the first transaction costs $50 million to build the system. but the millionth transaction costs like a fraction of a cent in server space.
Precisely. So when volumes drop during a mortgage winter, it hurts, obviously, but the fixed costs remain static. Now that the thaw is beginning and transaction volumes are creeping back up, that $2.9 million isn't just a tiny profit.
Right.
It is the proof of concept that the toll road has cleared its fixed costs. So from this inflection point forward, a huge percentage of any incremental revenue they add doesn't just grow the bottom line linearly. It accelerates it exponentially.
Okay, so if the toll road is finally clearing its maintenance costs and turning an operational profit, we need to look at what kind of traffic is actually driving that base revenue, which leads us directly into their foundational engine, the U.S. appraisal segment.
Right. The U.S. appraisal segment is the workhorse of Real Matters. It's the mature engine paying the bills and basically keeping the lights on while the rest of the business scales.
And the data certainly reflects a very steady engine. Revenues in the U.S. appraisal segment were $33.7 million, which is up 26% year over year. Adjusted EBITDA for this segment alone was $3.6 million, which is a really solid 41% jump from last year. And the segment's adjusted EBITDA margins expanded from 35.4% up to 42.1%.
That's a big jump.
It is. And management attributes this to a stable purchase market, a rebound in some refinance activity, and successfully capturing more market share in specialized areas like home equity appraisals.
Which is a textbook demonstration of the operating leverage we just discussed. I mean, they are pushing 26% more revenue through the exact same software system. And because there are no new fixed costs to eat into it, the raw profit jumps by 41%,
right?
Driving those margins well past the 40% mark. That is an incredibly healthy, highly optimized segment.
It is, but here's where it gets really interesting and kind of counterintuitive. When you dig into the segment's granular metrics, there's a curious anomaly.
Okay.
While total revenue is up and total operational profit is up significantly, their net revenue margin actually shrank.
Right, yeah.
The report notes it dropped by 170 basis points. For those of you listening who don't spend weekends reading Wall Street technicals, 170 basis points simply means 1.7%, so it dropped to 25.6%.
Correct.
If revenue and actual cash profit are surging, how does the percentage they keep, after paying the independent appraisers, actually go down?
Yeah, it looks like a total contradiction on paper, but if we connect this to the bigger picture of corporate expansion, it actually makes perfect strategic sense.
Okay, how so?
Well, the report specifically points to a shift in geography, clients, and product mix as the root causes of this margin compression. Let me break down the mechanism behind that.
Please do.
Imagine a company sells a mix of high-margin luxury goods and lower-margin everyday items. If they suddenly sell a massive volume of those everyday items, their overall profit percentage, their blended margin, goes down.
Because the pool is heavily diluted by the lower margin product.
Exactly. But because they sold a massive volume overall, their actual bank account gets much larger.
Ah, I see. So it's the classic volume versus margin trade-off. They are making slightly fewer dollars per individual transaction on something like, say, a home equity appraisal in a new geographic state. But they are more than making up for it because the pipeline is absolutely flooded with those specific transactions.
Exactly. They are actively choosing to capture market share in regions or product lines where the baseline transaction costs or the fees paid out to the independent appraisers might yield a slightly lower net revenue percentage.
Right.
But again, because of the digital toll road, it costs the company virtually nothing extra to facilitate those transactions. It dilutes the ratio, sure, but it pours significantly more total cash into the profit bucket. And, as any business operator knows, you take dollars to the bank, not percentages.
That is a really vital distinction.
Yeah.
It's the difference between protecting a pristine ratio on a spreadsheet and actually generating raw cash. And while the U.S. appraisal segment is methodically generating that cash, a toll road isn't truly tested by its steady daily commuters, right? It is tested when a sudden mass migration happens. And right now, according to this report, there is a massive migration brewing in their U.S. title segment.
The U.S. title segment is where the most aggressive structural growth is happening right now. This division is intimately tied to the refinance market, and the data here is indicating a major shift.
The acceleration here is stark. U.S. title revenues surged to $5.1 million. That's up 127% year over year. Net revenue hit $3.3 million, up 176%, maintaining a very high 63.3% margin.
Yeah.
But the underlying driver is what really caught my eye. Refinance origination revenues skyrocketed 271% year over year.
It's wild.
It is. The report highlights that the refinance volume processed in this single quarter, Q2 2026, matched the entire total volume they processed in all of fiscal 2023, and it matched all of fiscal 2024.
Wow.
One quarter just equaled 12 months of business from the depths of the mortgage winter.
It is a massive acceleration. But what's crucial is that they aren't just passively riding a macroeconomic wave of lower rates. They are actively capturing new territory.
Right.
They launched 4 new lenders in Q2, including one of the largest non-bank servicers in the United States. And right after the quarter ended, they announced the launch of a third Tier 1 lender alongside another top 100 lender.
Let's define Tier 1 lender for a moment, because that term gets thrown around a lot.
Yeah.
You aren't talking about a regional credit union here, right?
No.
A Tier 1 lender is a massive, highly regulated global financial institution, the big household names.
Exactly. The volume a single Tier 1 client can push through the plumbing of this system is monumental.
And the potential volume waiting to be processed is staggering. The report notes there are currently 13 million potential refinance candidates sitting out there with mortgage interest rates above 6%.
Right.
That is 13 million households highly incentivized to refinance the minute rates become favorable.
Right.
But I have to stop and look at the bottom line again. We are talking about 127% overall growth, 271% refi growth, onboarding Tier 1 household name banks, and addressing a 13 million household market. Yet the U.S. title segment still operated at a loss this quarter.
They did, yeah.
Their adjusted EBITDA was negative $0.4 million. How does a division grow revenue by 127% and still lose money?
It's a critical question that gets right to the heart of how enterprise technology scales. First, we need the context of the trajectory. In Q2 of 2025, this segment lost $2.1 million.
Oh, wow.
Yeah. So reducing that loss down to negative $0.4 million, which is essentially approaching break-even, during a phase of massive hypergrowth is a huge operational improvement.
Okay, that makes sense.
The CEO stated the path to profitability for this segment is well within our sights. But to answer your question about why the loss exists at all right now, you have to understand the mechanics of onboarding a Tier 1 client.
Because it's not just handing them all login and a password to the website.
Far from it. When you sign a massive global bank or the country's largest non-bank servicer, you are integrating your digital plumbing with their legacy IT systems, many of which, by the way, are decades old.
Right.
You have to build custom API bridges. You have to endure brutal month-long security and compliance audits. You have to train their entire internal teams. And most importantly, you have to aggressively build out your own localized network of title agents to handle the specific geographic footprint that bank requires.
I see. It's like laying fiber optic cables to 1 million unserved homes.
Exactly.
The potential revenue is enormous, but you have to spend millions of dollars digging trenches, laying the physical wire, and testing the connections before you can ever turn the signal on and charge a monthly fee.
That is the perfect analogy. They're executing heavy upfront capacity investments. They're spending money today to build the digital on-ramps and off-ramps capable of handling the volume of a Tier 1 bank. It creates a short-term drag on their earnings, hence the $0.4 million loss.
Right.
But once those trenches are dug and the integration is complete, they capture immense, deeply entrenched long-term market share. They are sacrificing a fraction of short-term profit to secure the infrastructure for that 13 million household migration.
But doing that kind of heavy infrastructure work, digging those digital trenches, it requires serious capital.
Oh, absolutely.
You cannot aggressively lay thousands of miles of fiber optic cable if you're stressed about making your own interest payments and keeping the lights on at headquarters. Which means to understand how Real Matters can afford to play this aggressive long game in the U.S., we have to look at how they are funding it. And that brings us to their Canadian operations and their overall corporate balance sheet.
The structural anchor and the war chest.
Exactly. The Canadian segment functions quite differently from the U.S. side.
Mm-hmm.
Looking at the data, Canadian segment revenues were totally flat year over year at $8.4 million. Now, the macroeconomic data shows that the actual Canadian mortgage market actively declined during this period. The report notes that Real Matters offset that underlying market decline purely through favorable foreign exchange rates.
The currency dynamic is definitely providing a buffer on the top line.
But, I've got to raise a skeptical eyebrow at that as a business strategy.
Yeah.
If the actual underlying market is shrinking, you can't build a long-term corporate strategy on favorable currency exchange rates unless you're a Forex day trader.
Right, yeah.
Exchange rates are entirely out of the company's control. What happens if the Canadian dollar strengthens?
This raises an incredibly important question about the difference between top-line revenue and underlying operational health. You are absolutely right. Relying on foreign exchange to mask a declining market is a temporary shield, not a strategy.
Okay.
But if we look deeper into the mechanisms of the Canadian segment, the FX rate isn't the real story. The real story is their absolute operational efficiency.
Squeezing blood from a stone.
Precisely. Even with flat revenues in a shrinking macro environment, their Canadian segment hit a new record high net revenue margin of 19.9%.
Wow.
Yeah. And their actual cash profit, their adjusted EBITDA, went up 3% to $1.1 million. They also successfully launched 3 new clients in Canada during the quarter. So they aren't just passively letting the exchange rate float their numbers, they are actively optimizing.
Right.
They are squeezing more value and more profit out of every single transaction that flows through the Canadian system. They are doing more with less.
So while the overall pie in Canada is shrinking, they are engineering a way to take a slightly larger and significantly more profitable slice of it.
And when you combine that hyper-efficient, steady cash flow from Canada with the mature, high-margin cash flow from the U.S. appraisal segment, you end up with the ultimate corporate war chest. Let's look at their balance sheet.
Okay.
They ended the quarter with $41.7 million in cash. We'll just round that to $42 million. And crucially, they have zero debt.
Zero debt.
None.
In 2026, that is an incredible strategic weapon.
It is a superpower. Think about the macroeconomic environment of the last few years. Interest rates are high. Capital is incredibly expensive. If a competitor wants to build the capacity to onboard a massive Tier 1 lender today, they likely have to borrow tens of millions of dollars at 7%, 8%, or 9% interest to fund those digital trenches.
Right.
The cost of simply servicing that debt eats their profit margins alive. Real Matters has $42 million in the bank and owes nothing to anyone.
They have the ultimate luxury in a volatile real estate market.
Right.
Flexibility.
Exactly. They can easily afford to absorb a strategic $0.4 million loss in the U.S. title segment. They can afford to invest heavily in complex software integrations and build out localized networks without ever having to ask a bank for permission or, worry about fluctuating interest rates on corporate debt. They are entirely self-funded in their expansion.
It really paints a cohesive picture of corporate strategy when you connect those mechanisms together. So, to summarize for you listening, we've just taken a deep dive into how the unseen infrastructure of the real estate world actually operates during a massive market transition.
Yeah.
We've seen how Real Matters is using a highly scalable tech platform to prove their operating leverage, turning incremental revenue into pure profit as the U.S. appraisal market revives. We've seen them aggressively invest in a burgeoning U.S. title refinance boom, absorbing short-term integration costs to capture massive Tier 1 clients and process a volume that just tripled year over year.
Which is incredible.
Truly. We explored how their Canadian operation is a masterclass in driving operational efficiency during a macro downturn. And we saw how all of this is backed by a fortress of a balance sheet, with $42 million in cash and zero debt, allowing them to patiently execute a long-term strategy.
It is a real-time lesson in the physics of network economics. And the foundational infrastructure is strong and the balance sheet is clean, a company doesn't just survive the winter. They're uniquely positioned to capture the spring.
And as we wrap up, there is one final thought that emerges from this data, something for you to chew on long after this deep dive is over.
We keep going back to that number. 13 million people currently sitting on mortgages with interest rates over 6%. They are all just waiting. If market rates drop even slightly and millions of those homeowners all rush to refinance at the exact same time to save hundreds of dollars a month.
I'd say it will.
They absolutely will. But will the traditional, highly fragmented legacy real estate network physically be able to process that bottleneck? Or is a centralized digital network management platform like Real Matters no longer just a technological advantage for a lender, but an absolute structural necessity for the financial system to function without breaking?
A wave of 13 million refinances suddenly hitting a decades-old plumbing system. That is a fascinating and somewhat terrifying image to leave you with. Thank you so much for joining us on this deep dive. Keep asking big questions, keep looking at the hidden plumbing behind the walls of the economy, and stay curious.